Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss lead lag effect in mistyped tickers.
Hello everyone, my name is Radovan Vojtko, I'm CEO and the head of research at Quantpedia. Today we will try to find out how to earn money on other people's mistakes. How to do that? We have a very interesting article. It's called "Oh My, I Bought the Wrong Stock. Investigation of lead lag effect in easily mistyped tickers." What is that article about? We are trying to investigate the lead lag effect between prominent, widely recognized stocks and smaller, less known stocks with a similar ticker symbol. So we have an example. So we have a very well known stock, Tesla, which has a ticker TSLA, but there is another company which has stocks listed on New York Stock Exchange, and it has a ticker TLSA. So those two stocks can be very easily mistyped, and there are a lot of the people who try to buy Tesla, but instead of buying Tesla they buy the different stock. So what we are trying to find out is if there is some lead lag relationship between the performance of the leading stock, so the stock which is usually the big company, very well known company, and the smaller company which has a ticker that's very close to the ticker of the bigger company. I mean, we are not the first one who is investigating these effects, so there are a lot of the other papers, there is a lot of existing literature. So if you are interested to learn more about that, I would really recommend you to go through our list of existing literature. So there are articles, there are papers that are related to this effect. What are the data that we are using? So our data sample starts at the end of May 2019. And our study ends at the end of March of 2024. The length of the study is approximately 5 years. We are trying to find stocks that were not bought but somebody, that were not taken private, that are not a pink sheet stock, not penny stocks, so there are stocks that are traded at the moment at New York Stock Exchange. So here is our list of larger companies that should lead the smaller companies. So among the larger companies are well-known names like Tesla, Ford, Apple, Hewlett-Packard, Snap or Zoom. Then we have the lagging stocks, or the stocks that should follow the leading stocks. They have like very similar ticker, but they are different companies. So for example, for TSLA we have a Tesla, and for TLSA we have a Tiziana Life Science. Once again, Ford Motor Company has a ticker F, but there is a company called Forward Industries which has a ticker Ford. So you can very easily exchange those tickers between each other. The Apple has a ticker AAPL, and Advanced Auto Parts has a ticker AAP, etc. So there is Zoom Video Communication, which has a ticker ZM, and there is Zoom Info Technologies, which has a ticker ZI. So it's very easy to exchange those two tickers, and that's the reason why we picked those stocks. Of course, there is a systematic way how to find stocks that are connected this way. So our study is not statistical, so I mean we picked subset of stocks and we try to find out if there is a lead lag relationship, but I mean it is possible to do this more systematically, so to create a bigger universe of leading stocks, bigger universe of lagging stocks. How do we do the investigation, or what are we interested in? So we are not interested in daily or intraday trading. So we are, not interested what will happen if leading stock like Tesla announce some news and the lagging stocks jump together with the Tesla, or I don't know, a few minutes after that or something like that. So what we are interested is find out the relationship that's on a longer horizon. So what we are interested to see if there is a lead lag relationship in case the leading stock goes significantly up over the period 3 to 12 months, whether the lagging stocks also follows. Usually it is because there is a buying pressure from the people who are trying to buy the leading stock like the Tesla, but make the mistakes and buy the smaller stocks. There are different ways how we can weight the final portfolio. Our idea is to, let's take the investment universe that consists of leading stocks. Let's take out a look at how the stocks are performing over the horizon 1, 3, 6 months or 12 months. As an example, if the Tesla is outperforming on 12 months, so it has higher performance than 0, so it has a positive performance, positive momentum, we buy for the 1 month the lagging stock. So instead of buying Tesla, we buy the TLSA ticker. Now in this case, we can have two types of the weighting. We can have a proportional fraction, so it means we will invest 100% of our money in the long portfolio, 100% in the short portfolio. And in case there are some stocks that we should have in a long portfolio, we will split our long portfolio evenly between them. So in case there is one stock, it has 100% weight. If you have 3 stocks, each of them have 43%. That's the proportional. Or we have a fixed weighting, so we always invest 1/8 into each stock because we have 8 stocks, so 12.5%. No better if you should go long the stock or if you should go short the stock. Let's take a look on strategies. So firstly, let's focus on the long only strategies. They are easily traded and can be interesting for retail investors. And later we will take a look on the long short strategy variants. Here is firstly fixed long only portfolio. So here we use a fixed weight. So we allocate 12.5% to each stock and we go long the stock in case we go the lagging stock, the small cap stock, in case the leading stock like a Tesla or Ford or Hewlett-Packard performs well. In case it doesn't perform well, we do not hold any position. What you can see is that there is significant jump in performance in 2020, but after that, plus or minus, the portfolio is flat. When we do the proportional long only portfolio, the pattern is plus or minus the same, so there was a significant jump in the performance in 2019, 2020, and after that, the portfolio is plus or minus flat. Of course, the portfolio is significantly more volatile because we are giving higher weight to the stocks. So if we have just 3 stocks in the portfolio, we put 43% weight into each stock and not 12.5%. Now, in other case, we will try to take a look on the long short portfolio. So first we will check how does it look like when we have the fixed long short portfolio. So we go long if the leading stocks has a positive momentum, and we go short the lagging stock if the leading stock has a negative momentum. Here we can see that the Sharpe ratio is significantly better. The strategy performance are relatively fine. We have to short the stocks. The 1 month period is not performing very well, but 3 months, 6 months or 12 months period used for momentum indicator works really nice, and we have nice Sharpe ratio and we have a long short portfolio, so that's market neutral. The performance is not just in 2020, but it's spread over multiple years from 2009, 20, 21, 22. Now when you have a proportional long short portfolio, the performance is significantly higher in some cases, but volatility is significantly higher too. So what is the conclusion? Firstly, this article should serve just as a high-level overview. So we try to investigate the lead lag effect in misspelled or mistyped stocks. The disadvantage is that we have a small sample. We just have 8 pairs, which we identified, by hand, and they were arbitrarily chosen, and there might be significant subjectivity in the process. And we have also the limited period because we are backtesting only over the 5 years. So there are some steps that can be taken. So we will definitely turn our interest to extend the sample of the pairs, to have the systematic selection of the pairs. We would like to see what is the performance over the long horizon. But however, even in this small universe, so even when we have these 8 pairs, our article shows that there is definitely a potential to exploit the proposed lead lag relationship. So there is some relationship effect. It definitely makes sense to take a look on the stocks that are connected by how the tickers are spelled, and there is significant misspelled or mistyped effect between those stocks that can be exploited. And even our short example showed that it's profitable. So what we will look in the future is to expand the investment universe and extend the sample. And we will be interested to see what will be the performance and if we are able to increase the Sharpe ratio and increase the performance. So I hope that you like this article. If you are interested, go and see another videos. Please give us the like, please subscribe to our channel, and we will see you in the next video. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.